Professors FM.
I'm Bridget Stomberg.
And I'm Lisa DeSimone.
And this is Taxes for the Masses.
Today's episode is on the interplay between sports, taxes, and tax avoidance.
Professional sports is a popular and lucrative business. As of 2024, the average NFL franchise was worth almost $6.5 billion, and Forbes estimated that at least 11 professional athletes earn over $100 million annually. And with big incomes come big potential for taxes. In today's episode, we discuss some of the ways that athletes and professional sports teams avoid those taxes. Hello, Lisa.
Hello, B.
I am turning a corner and shedding my grumpy behavior because today's episode is about sports and taxes. I love sports. I love taxes. I guess I am like a kid in a candy store or nope. Let's keep with the theme. I am like a safety in the end zone after an interception.
After a pick six?
That would make it a pick six. You are correct.
I love it when I get some of the terminology right. I also love when you are happy. It's a rarity, but I enjoy it. And we've done several episodes on sports and taxes, like gambling winnings and taxing professional athletes. We did an episode on NIL, which kind of begs the question, are there seriously more episodes to be done on sports and taxes?
There are. There's this one, and then I can think of it. I have at least one more up my sleeve.
Oh, wow. Okay.
So everybody, it's a little teaser. But I will admit that today's episode is a little bit of a wild card because we're going to talk about the tax avoidance or tax planning strategies, whatever you want to call it, that mega athletes and professional sports teams sometimes engage in to lower their tax bills. So we're kind of talking about a lot of different little things today.
Okay. All right. I dig. So why don't we kick it off with a discussion of some tax planning opportunities around endorsement income, or really any income that professional athletes could receive related to their name, image, and likeness. Then we're going to give listeners the blow-by-blow of how professional sports teams and their owners save millions on taxes by amortizing intangible assets. I never thought the words amortizing intangible assets would sound so sexy.
I mean, it's kind of exciting. It's kind of fun.
I mean, to us.
I think people are going to like this one. All right. So rule number one of tax planning is don't talk about tax planning. No.
Yes. Rule number two about tax planning.
Yeah. So rule number one of tax planning is that when there's the possibility for a high tax bill, there is an incentive for tax planning.
Yuppers.
So let's look at LeBron James, King James himself.
I love looking at LeBron.
Not hard to do.
It's not hard to do.
No. So according to that article by Forbes that we referenced at the very, very tippy top of the show, James earned almost $130 million in 2023. Now, about $50 million of that came from actually playing the sport of basketball, and the remainder, the other $80 million, came from his off-the-court earnings from things like endorsement deals, which is what you referenced. Now, if we think back to 2023, it wasn't that long ago, the highest marginal tax rate for a couple married filing jointly was 37%. That's what it is now as well.
Yep.
So let's just keep things simple and say that means that as much as $48 million in federal income tax was what Braun would be paying on those earnings. So $130 million of earnings, $48 million in federal income tax. Stakes is high.
Yeah. Now, LeBron's earnings from team play is probably W-2 income, or in other words, income on wages, salaries, tips, etc. And that is the hardest form of income for people to try to tax plan around.
Yep.
There's just not a whole lot that he can do about it. It's going to get reported to the IRS as income. It's ordinary income subject to that high rate. There's just not that much you can do. The Tax Cuts and Jobs Act also did away in 2018 with deductions for unreimbursed employee business expenses. So working stiffs like you, me, and even LeBron pretty much have to pay tax on all of our wages without any deductions against it.
Yeah. But that's what we're talking about, income from him playing basketball. The income that he earns from endorsement deals could be taxed much differently.
Okay.
So like you said, this type of income is also generally going to be considered what we call ordinary income, subject to that same high 37% rate. But James could earn that income through a business and offset it with deductions for all sorts of things, like maybe compensation that he pays to agents and managers. He can offset it with travel expenses, legal fees, etc. The list of things that he can write off against that income to make his taxable income lower goes on and on.
That's right. And as long as those deductions are, quote, ordinary and necessary, end quote, James can write them off to reduce his gross endorsement income. So that's going to lower his tax base, but not necessarily his tax rate. And the key here is that they are supposed to be an ordinary and necessary part of doing the business that earns him that income.
Okay, so you just said it's going to lower his tax base, but not his tax rate. Say more things.
Yes. Okay. Maybe an example would help here.
Okay.
LeBron earned about $80 million from endorsement deals, as you said. With no expenses, he'd owe about $30 million at a tax rate of 37%.
Okay.
But now let's say LeBron claims $10 million of those write-offs, of those deductions against those gross earnings. Now his taxable income or his tax base drops from 80 million to 70 million, and his taxes drop to about 26 million from the 30 million that they were at before. But we haven't changed his rate. He's still paying a 37% tax rate.
Okay, roger that. So paying fewer dollars is the key here. He's not lowering the rate, but he's lowering the number of dollars that are exiting his pocket.
Yep.
Great, love that. But isn't the real winning strategy to actually pay at a lower rate?
Yeah, and there are some opportunities to lower rates, but I'm going to call them limited opportunities.
Okay.
We talked on our first episode on the taxation of professional athletes and in our Shohei Ohtani episode about tax planning around state income taxes.
Yes.
And yeah, this is one key way that athletes can lower their overall tax bill by earning more income in low tax states rather than in high tax states.
Yep.
So that's one tax planning dial that we can turn, which is changing the location of where the income is earned, which, as you know, is one of my favorite topics.
It is. You income shifter, you. So this is coming back to me now. Tax planning can involve changing where the income is earned, which we just talked about. The other thing that you can do is you can change who receives the income.
Yep.
You can also change the timing of the income, or you can change the character of the income. So instead of it being ordinary, you can make it capital income that's going to get taxed at favorable rates.
Yep.
All right, so if LeBron earns most of his money in the U.S. and he doesn't want to pull an Ohtani where he's going to defer a big chunk of it until sometime in the future, then you are exactly right. He has more limited strategies at his disposal to lower his rate of taxation. Okay, so I think we need a better example.
Okay, well, fortunately, we have one.
Okay, excellent.
Our next stop in this tour of taxes and sports is how NIL can affect professional golfers who are not U.S. residents.
You said before amortization of intangibles was like an exciting phrase.
Sexy.
Or not? That thing you just said was a very specific phrase. Can you say that one more time?
Okay. There have been at least 2 cases where professional golfers who are not U.S. residents have gone head-to-head with the IRS over U.S. taxation of NIL income.
Okay, and who are these 2 golfers?
Retief Goosen and Sergio Garcia. Both Goosen and Garcia had endorsement deals with multiple companies, including TaylorMade, to use their name, image, and likeness for merchandising and advertising. Both players were also obligated to use the company's products during play. And even though neither were U.S. residents at the time of their lawsuits, they were both subject to U.S. tax in the U.S. To determine how much tax they owed, Goosen and Garcia had to determine both the character and the source of the income from their endorsement contracts. And there's the rub.
Okay, so let's talk about character, because this seems like we're going to be having a character play here.
Okay.
So in general, the U.S. is going to tax non-resident individuals only if they engage in a U.S. trade or business or receive what we call FDAP, fixed and determinable annual or periodic income.
Yep.
If a non-resident athlete performs personal services in the U.S. from things like playing in golf tournaments or making appearances on behalf of a company that they represent, then the U.S. is going to tax that earned income, net of allowable deductions like we talked about, as ordinary income. Back in the early 2000s, when Retief Goosen and Sergio Garcia filed the tax returns in question, the highest ordinary tax rate for individuals was 39.6%.
In contrast, royalties are considered that FDAP, that fixed and determinable annual or periodic income, and that FDAP is subject to a flat 30% tax rate. That tax rate can actually be lower if the U.S. has a treaty with the athlete's home country, and in some cases, royalty income of non-residents completely escape U.S. taxation.
Okay, so you can start to see what's going on here. If Goosen and Garcia considered that income that they earned through their endorsement deals as ordinary, it was going to get taxed at like 40%.
Yep.
If they can make an argument that it was FDAP, it was going to get taxed at a max of 30% and probably something lower than that.
Right.
Okay, next thing we have to worry about for Goosen and Garcia is what is the source of their income? Where is that income considered earned?
Okay.
So the rules say that personal service income is sourced to a country based on where the services are performed. So money that either of these players earned for playing in a golf tournament, if that golf tournament was in the U.S., would be considered U.S. sourced ordinary income. That's pretty straightforward. You know what country you're in when you're playing golf,
when
I
you're
hope.
doing the thing.
Yes. Now, in contrast, royalty income is sourced to where the property is, quote, used or granted the privilege of being used. So you can see that when we're talking about royalties, things are getting a little bit squishier.
Yeah, so this exercise of distinguishing personal service income from royalty income is going to be really, really important from a tax perspective.
Yep.
Allocating income from endorsement deals into those buckets can be a bit tricky.
Yeah.
So let's start with how Goosen did it. When he filed his U.S. tax returns in 2002 and 2003, he asserted that the money that he earned from his tailor-made endorsement was 50% royalties and 50% personal services income.
Okay, and just to keep everybody on track, that meant that 50% of it was going to be taxed at that higher rate, and he was going to pay tax to the U.S. for the games that he played in the U.S.
Right.
The 50% of royalties was going to be taxed at a lower rate, and maybe not all of it was going to be sourced to the U.S. because you'd have to determine where the, quote, privilege of using that property was sourced.
Which may not have been in the U.S. if he played a bunch of tournaments outside the U.S. as well.
Absolutely. So not surprisingly, the IRS disagreed with Goosen's 50-50 estimation and instead said that all of his endorsement income was personal service income, taxable at that higher rate, which I think is hitting below the belt. But this is why we have the judicial system in the country. Goosen said, no, thank you, took it to court, and the tax court actually sided with his 50-50 allocation. The tax court reasoned that, quote, an athlete's image is often more important than the athlete's performance on the course. So the point being that even when Goosen was playing in tournaments on U.S. soil, which would be U.S. sourced personal service income, the court thought that part of the compensation that he was receiving from TaylorMade for playing that game should actually be characterized as royalty income. Because even if he didn't place, even if he didn't win, he was still advertising by wearing their hat and carrying their bag and their shirt and all of that during the tournament.
Okay, so he got to preserve his 50-50 allocation.
Absolutely.
All right, turning to Sergio Garcia, he claimed that only 15% of his endorsement income was related to personal services. Thanks to favorable terms in the U.S.-Switzerland Treaty, and I'm assuming here that Garcia is a Swiss resident despite having what seems to be a very Spanish name.
That's my best guess.
Okay. Garcia would avoid paying any U.S. tax on the remaining 85% of endorsement compensation characterized as royalty income. Again, the IRS did not like this.
Nope.
They took the matter to court, and in this case, the court concluded that only 65% of Garcia's endorsement income should be characterized as royalties, not 85%.
So the question here, we've got two people, same company, TaylorMade. They're doing the same thing. They're playing the tournaments. They're wearing the stuff. So one might ask, why did the court let Goosen characterize only 50% of his income as royalties, but Garcia was characterizing 65%? So that's different treatment for two seemingly similar things.
It does seem like it's different treatment, yes.
So the court reasoned that because Garcia was considered a TaylorMade, quote, global icon, whereas Goosen was only a brand ambassador, that there were differences. So Garcia's name, image, and likeness was deemed to have a higher value to TaylorMade because he had this label of being a global icon, such that more of his compensation could properly be characterized as deriving from the privilege of using his personal IP and therefore considered a royalty.
Okay, well, it makes some sense, I guess. Rich athletes clearly can afford to have a team of advisors and accountants trying to get them the best deal.
Yeah.
And it was no accident that Garcia tried to maximize the amount of his endorsement income characterized as royalties and therefore subject to a lower rate or perhaps even non-taxation by the U.S. altogether. And it's not just golfers. A 2022 article in The Mirror reported that the UK's tax authority was investigating 329 professional footballers, as in kicking the ball, not helmets and shoulder pads.
Correct.
For tax avoidance linked to compensation from image rights.
And so this is interesting because a little while ago we said you can tax plan by changing where you earn the income, changing the character of the income, which we talked about, or changing who earns the income. So in these particular cases of the footballers, what is happening is that the players are setting up separate entities or companies to sell or license their name, image, and likeness to their football clubs. The club then compensates the company instead of directly compensating the player. So as I just said, this form of tax planning is changing who is earning the income. And it works in this case because the company as a legal entity pays tax at a rate of only 19%, whereas the player as an individual, if they were receiving the compensation directly, would pay tax at a rate of 45%.
Sounds like a slam dunk to me. We've talked about things from the athlete side. Let's turn now to the team owners.
Yes, let's do that. So not surprisingly, being a team owner in the U.S. is quite lucrative. As of January 2025, the most valuable U.S. sports franchise was valued at over $10 billion. Any guesses from you as to who that team is?
Ooh, I'm going to guess sport is NFL.
Correct.
And I'm going to guess it's a major market.
Correct.
I mean, I would think like one of the New York teams, although the Cowboys might be up there. They are supposedly America's team. I'm going with the Cowboys.
That is correct. Well
Really?
done. Well done.
Wow.
Yes.
Mostly because I cannot name the New York teams. there's like Giants
Yes.
and then there's other stuff. Okay.
The Giants and the Jets and the Bills, if you want to count them. But, you know.
Oh, yeah. I could have named the Bills, but I wasn't thinking Buffalo as a major market.
No, nobody's thinking of Buffalo, sadly. Sorry, Josh Allen. Yes, you are correct. $10 billion for the Cowboys. That's a lot of money.
That is a lot of money.
So thing is, in the U.S., we don't tax wealth. We tax income.
Yes.
So Jerry Jones and the other owners of the Cowboys, if there are any, aren't going to have to pay tax on that $10 billion each year. They're only going to pay tax on how much revenue, or rather taxable income, the franchise generates. But the Cowboys did make $1.2 billion in 2023. So,
wow, that is a lot of beer and nachos.
but now I get to say, but not a lot of wins. But
Oh, snap. It's true. It's true. I didn't follow a lot this season, but I saw enough to know that the Cowboys stunk it up.
it was not great. But you know, go Birds.
Fly, Eagles, fly. The good thing about being a team owner is that it is a business.
Yes.
And so that's what I'm told.
Yeah.
It's not just, showing up in your box and
No,
collecting trophies.
Andy Reid did everybody a favor by saying it's not a hobby. So we're avoiding those hobby loss rules. Thank you, Andy. Thank you, Big Red.
Okay, so because these things are treated as a business, that means that the gross income from the team is going to be taxed most likely at ordinary rates, but it can be offset with those ordinary and necessary business expenses. So unlike LeBron's wage income that he cannot reduce with business expenses, Jerry Jones can take his share of the Cowboys' gross income and reduce it with his share of the Cowboys' expenses.
And I did just confirm with the interwebs because I just so associate Jerry Jones with the Cowboys.
Right.
He is not, in fact, the sole owner of the Cowboys. He and his family own the team with their 3 children. So there you go.
The Joneses, then. Keeping up with the Joneses.
Mr. Jones and me. All right.
Wow, that was a throwback.
So yeah, Jerry Jones, his 3 children, whatever, they can take their share of income from the Cowboys. They can reduce it with their share of expenses. And one particularly large tax deduction, so large that it was actually the centerpiece of a 2021 ProPublica article, is in fact the amortization of intangible assets.
I think it's sexier when you say it, but either way, it's a sexy phrase.
It's just my voice right now.
It's true. You've gone a little bedroom voice.
Yes.
Yeah. You're such a tease. All right, stay with us here. When an individual or group of individuals purchases the assets of another business, say a sports franchise, they have to allocate the total purchase price to each of the assets that they're acquiring. Any amounts allocated to intangible assets, and these are going to include things like player contracts, TV deals, endorsement deals, they're going to get capitalized and amortized over 15 years. And that means the buyers don't get a deduction for those amounts all at once, but ratably over a 15-year period.
All right, so we're going to stay in the NFC East because that's where I spend most of my life anyway. Washington Commanders were just sold and bought for $6.05 billion.
Okay, did the name Commanders improve or hinder their purchase price, do you think?
You know, it was better than the prior two. And I just heard recently, I guess there was some discussion about whether they were going to keep it. And I think they've decided to keep it.
Okay.
So there you have it. It's fine. There are worse things that you could be called. Now, by some estimates, as much as 90% of that purchase price will be allocated to intangible assets, the things you just mentioned. That means that the team owners will get a deduction of just over $360 million each year to offset the gross income that the Commanders earn.
Forbes estimates the Commanders made just over $600 million in revenue in 2023. That means the $360 million amortization deduction would shield more than half of their gross income from tax. And they have other deductions for things like staff salaries, supplies, travel, etc.
Yeah, and like it or not, there's nothing. Zip, zero, zilch. The Kansas City Chiefs score through the first three quarters of the Super Bowl. I mean, we're talking about zero.
Well done. Yep.
There's nothing illegal about this.
Yeah.
This is a perfectly legal deduction. So thank you, Code Section 197, which allows all taxpayers, not just sports team, any taxpayer, to write off the value of acquired intangibles acquired in a business combination over 15 years. It's just the rule.
Exactly. The game to be played is around the valuation of those intangibles.
There you go.
Of course, the teams have every incentive to record very high valuations, so they get that higher write-off over 15 years. The IRS can try to disagree and fight back, but
They have no money.
they have no pens.
They have no staff.
They might have most of their funding revoked in the next few months.
They might be turning into the External Revenue Service.
Yeah, the IRS is definitely the underdog in this fight for sure.
Time for the good, the bad, and the ugly. And I'm happy whenever we talk about sports to start with the good, because sports.
Yeah, you're such a fan. I love it.
I
I also love that we are not fans of the same sports, but we're
No.
sports fans nonetheless.
I have often thought if I were going to be a baseball fan, what team I would be a fan of. And I
Really?
don't think it would be the Dodgers. Yes.
Well, I'm not at all surprised by that. Everybody hates the Dodgers except for me. But what surprises me is that you have often thought about this. So it's like it's
I have.
almost like you want to be a baseball fan.
No, I don't think that's it. It's just, you know, we are introverts and we can occupy our minds with thoughts of many, many things.
Yes.
But yes, we love these episodes or, you know, similar episodes because not only is it a fun topic, it also provides some interesting, appealing case studies where we can illustrate some complex tax issues with some practical examples that, you know, people can kind of ground onto, right? If you know who Retief Goosen is, if you know who Sergio Garcia is, you can picture them in the tailor-made cap. You can understand this idea that they're kind of doing two things at once. They're earning money from playing golf. They're also earning money from being a human billboard.
Yes.
And the challenge is figuring out how to characterize that income. And that matters because it affects the tax rate that income is subject to. So I thought this was good.
Turning to the bad, we pointed out that these types of tax planning opportunities, particularly the ones where you can take all these deductions, including the intangibles amortization deduction, they're not available to just anyone. It's not like I can easily come up with some purchase that I make that allows me to take some big deduction for intangibles.
No, and that's a good point because the way that the code section is written, you have to buy the assets of a business, right? So you can't just go out and buy an asset and like computer and say,
Right.
I'm going to, do something fancy and amortize this or depreciate it. You have to be buying the assets of a business. And what I thought was so interesting about this is, yeah, there are a lot of athletes who have those endorsement deals, but there's a lot who don't. And if you don't have an endorsement deal, you can't be considered a self-employed individual, right? And it's really the self-employed individuals and the business owners that benefit the most from tax planning opportunities because, like you said, they have income that isn't going to be third-party reported to the IRS by somebody. And they have the ability to offset their income with expenses. Those are really the two things that you need. You need someone not being able to verify every single dollar that you earned
Yep.
and telling it to the IRS, not behind your back because they're telling it to the IRS. And you need the opportunity to reduce your income with expenses, and just regular Joes and Janes and whatever don't have that opportunity.
And that kind of starts to get us to the ugly, which is that because it's not just the regular Janes and Johns who are able to do this, it's people who tend to have a lot of resources. They can also fight enforcement in a fight that really isn't a fair fight at all.
Yeah, absolutely. And they know that they can,
Yeah.
right? I would say the average taxpayer is like infinitely more afraid of the IRS than they need to be.
Yes.
And I'm not saying people should be going out and like breaking the tax law. That's not what I'm saying. But there are plenty of people who like are eligible for legitimate tax planning strategies and like don't take advantage of it because they are so afraid.
Yeah.
If you're really wealthy and you have an advisor, you're not ever even going to talk to the IRS.
Right. Yeah. And so on the flip side of being afraid of taking deductions you even qualify for, I think that puts some of these people in a position where they have the resources. It's not going to be their problem. It's going to be somebody that they pay's problem. They can be as aggressive as they want. It doesn't bother them,
Yes.
right? They're really going to push the envelope on this stuff, especially knowing that it's not a fair fight against the IRS.
Yeah, that's an excellent point. It's always been skewed in the favor of wealthy taxpayers, I think, forever. And that is just getting more and more skewed as we continue to cut resources to the IRS. So you're exactly right. And to just drive the point home, that ProPublica article that we referenced estimated that Steve Ballmer, who is the owner of the LA Clippers and who just happens to be a billionaire, if you look at his income tax return, which I think this was part of the leak, he reported over $1 billion of income and paid a tax rate at like 11.6%. They're estimating an 11.6% tax rate for Steve Ballmer, the owner of the Clippers, but they're estimating like a 40% tax rate for the athletes, LeBron James, Anthony David, and Floyd Mayweather.
Steve Ballmer is hitting a grand slam.
Yeah, because he's owner of a sports team, probably, considered himself self-employed or is earning this through some sort of business entity that can offset that income with expenses, whereas the athletes themselves, unless they have significant endorsement deals, aren't in the same position to do that.
Game over. Well, that's all we have time for today.
Be sure to join us for more tax nerdery on future episodes of Taxes for the Masses.